Stocks or real estate? Which is a better investment for a dentist? More specifically for our conversation and our channel, we're talking about passive investment in real estate versus stock. That's a safer comparison because there's more of a passive element involved with both of them versus active real estate investing. Now, some of us have already discovered that the stock market casino is not a predictable way to build wealth. A lot of us don't have the stomach for it. It gives us anxiety, and we'd much rather get into something that's understandable, take us from point A to point B in a very predictable and as a linear or potentially exponential path as possible. But the good thing about stocks is it's very easy, right? All you can do is open an account, maybe even give it to a manager or a mutual fund, and just dump it in, set, forget, and that's it. After all, we're busy doctors, we have families, we have businesses that we're growing, we have patients to treat, families to spend time with, and things to do. The last thing we have to do is to spend time doing yet another activity. And for some of those people that do invest in stocks because of its ease, they know that real estate is the great way to make wealth. In fact, it's the most predictable path to building wealth in this country, period. As soon as a doctor thinks about, hey, how am I gonna go find a property, then get a loan on it, then I gotta deal with tenants, and if there's broken a toilet, stinky toilet I gotta fix. I don't have time for that, nor do I want to do all of that stuff. So when you actually look at the active time that's involved with investing in real estate, it becomes a no-brainer for a lot of them busy doctors and dentists. It's, hey, look, I don't have time for this. I don't have time to go do that, so I'm just going to do stocks, so that's all that I really have access to. But now, boom, after 2012, enter the world of passive investing, enter the world of the accredited investor. Passive investing in real estate allows you to remove the time aspect and allows you to participate in real estate investments without having to do any of the day-to-day work or the active component of real estate investing. Let's look at the pros and the cons of both and help you decide which is the best investment for you. All right, guys, welcome back to the channel. I'm your host, Dr. Jonny Walker, aka Jonathan Withananchi. I'm a veteran endodontist, a 16-year real estate investor, as well as the principal and founder of Walk of Wealth, which is a real estate investment company with a mission to help 1,000 people achieve financial freedom through passive investment in real estate. As a quick aside, if you haven't joined our Facebook group, join it. It's called Financial Freedom for Dentists. We have a weekly live show. We interview other doctors. It's a great community, great place to learn, collaborate, learn from each other, get much more access to me. We give away tons of resources, as well as discounts on our live and virtual seminars and retreats. Let's compare the two with 5 different parameters and look at the pros and cons of each. Number 1, rates of return. Now, the stock market over the last 15 years has returned on average about 7.25%. Over the past 30 years, it's returned 9.06%. This doesn't sound too bad, right? But then there's assets under management fees and fixed expense ratio fees. Let's just call that 1%, right? Because a mutual fund's going to be 3, an index fund's going to be 0.1%. Let's say an average of 1% blended across. That takes it down to 8.06%. Now let's take in the fact that there's volatility, right? So during down markets, we discussed it crushes compounding effects. So take off 0.5% for volatility. Now you're down to 7.5. Next, you factor in long-term capital gains taxes and inflation, right? Say inflation is well over 8, 9, 10%, just a couple years ago. But even at inflation of 3%, which we're at right now, you take off another 3%, and then you're left with a net gain or net return of 3% or 4% per year. Now try and retire off of making 3% on your money. Now let's compare that to the returns in multifamily real estate. The returns have been double-digit for many, many years. It's something that's not publicly discussed or disclaimed because this is the world of private offerings. These are private deals. A lot of them happen. Nobody knows about it. There's no public reporting. I mean, other than to the counties and state. However, there's a major reason that the wealthiest families in America have major holdings in multifamily real estate. It has a track record of 250 years, and it's truly a recession-resistant asset class. It does well even during downturns, right? When people are in bad economic conditions, they're not buying homes when interest rates are high, and as a result, they remain renters. The more renters, the more pressure it is on renters, the more pressure it is on the affordable housing. With a mass scarcity of affordable housing in America, this creates natural upward pressure on rents and income. So that creates a recession resilience. We can see the returns, it's not really close. Well, let's take a look at the next parameter. What about risk? Well, the stock market is just point blank range is much riskier than the real estate market. It's volatile, it's going up and down. Nobody really knows what even causes all of that to go up and down. And we are at the whims of arcane market forces. And some people say, hey, it doesn't matter to me the day up and it goes up and down because I don't care. I'm a long-term investor, and I know that if I wait long enough, the market always goes up. This is the general rationale that I hear from most stock investors. But what about planning for retirement or planning for your school kids when they get to college age? If you have a market that's up and down, how does that allow for predictable planning in the future? What if your market's down 30%? It's a down year and it takes several years for it to come back. right when you need that liquidity event. Now you're in a position that you either take that money at a lesser amount or you stave off using it and hope that it comes back sooner than later. Let's take passive investing in multifamily real estate, for example. The risk is very low. The volatility is very low. Apartment buildings are like cash producing businesses. They're cash flowing machines. If you invest correctly, there's always demand for your product. People always need a place to lay their head and sleep. And for that, they are willing to pay money. So this allows a great certainty of income, a high predictability of outcome. In addition to that, you have the ability to mitigate risk factors even more by choosing where you invest, what asset class you invest with, who you invest with, etc. All right, so that didn't look too good for stock market. Let's check it out in parameter number 3, which is cash flow. Stock market, there is no cash flows. Sorry. Some people have portfolio income, dividend, but these are very small and insignificant relative to the size of the portfolio. On top of that, these dividends are taxed as ordinary income. And if you're already a high earning income, all this does is jack up your taxable income so they can tax you to the max. Now let's compare that to real estate. Real estate, especially multifamily real estate, these are cash flow machines, like we talked about. They will literally put money directly into your bank account monthly or quarterly. Usually distributions are every month, and in some cases it's every quarter. But regardless, once those apartment buildings are churning out cash flow, then you as a passive investor, you get to participate in those cash flows and you get the income. The incomes can be substantial, especially depending on what kind of deal you do. On top of that, what's even better is that income is income tax free due to an IRS deduction called depreciation. And depreciation allows the income from real estate to be income tax free or tax deferred. You don't have to worry about your ordinary income going up by getting passive income from real estate. And remember, with us as Walk of Wealth as a community, we invest for cash flow. We don't invest in things that do not create income because we depend on the income so that we don't have to depend on our jobs to pay our bills. And if we have enough income coming in that it covers or exceeds our bills, then we no longer need our jobs. So in order to achieve that optionality of employment, you need to invest for cash flow. And so real estate is going to hit that bill where stocks is not. All right, stocks is down 3-0, guys. Let's check number 4, tax advantages. Well, the stock market has tons of tax advantages. Not. Stocks have no tax advantages, and you get taxed to the max. If you get income from them, you're taxed. If you sell them too quickly, you get short-term capital gains tax. If you sell them long-term, you get long-term capital gain tax. Regardless, Uncle Sam is getting their cut. Oh, what about real estate? You already know what the answer is. I don't even need to do the rest of this video. Real estate is the most tax-advantaged asset class out there, period. The government has loaded the real estate playbook with tons of incentives. Why does the government do this? Because they are trying to promote the private sector spending time, capital, resources, flowing into building housing for the people. The government can't do it themselves. They don't have the equipment. They don't have the infrastructure to build housing. And so they need to stimulate more housing. And what do? They give huge amounts of incentives and tax advantages so that people will go and do all of these real estate activities, renovate units, et cetera, so that they can get tax advantages. The government's giving it to us, guys. All we got to do is use it and utilize these to our benefit. Otherwise, they're just there for those that are in the know. Watch, I have another video. It's talking about how to never pay taxes legally. Watch that video. It'll give you some in-depth looks at some of the top techniques that the wealthiest people in the world use. For the sake of this video, when it comes to taxes, just to mention them, refinance, 1031 exchange, qualified opportunity zone, these are all different real estate tax terms that you should understand if you want to save money on tax. And the last parameter, I hope that it's not a clean sweep and stocks loses in every single thing to real estate, is inflation. Well, ladies and gentlemen, we're in inflationary periods. We're headed for more bouts of inflation, and stocks and equities suffer largely during inflation. Right? They struggle, and people don't want to throw money into these things, and as a result, companies stagnate, and inflation has a negative effect on almost every type of business, except real estate, except multifamily real estate, right? So we have the ability to adjust our rents every 12 months as people's leases come up. And if the cost of construction, the cost of materials, the cost of business, of real estate business goes up, then guess what? We can adjust it by blip, 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 bumping up the rents to adjust for those increased expenses. And as a result, the net incomes increase and the underlying values of real estate, of commercial real estate, goes up based on the income. So inflation actually makes real estate investors richer. The last one I want to talk about is liquidity. Finally, one that the stock market wins. Ding, 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 ding. So liquidity, well, actually, no. There's been a replay, and we take back that. And it might not be an advantage. Actually, this is a tie. In the stock market, you have the ability to change positions in seconds. While you're watching this video, you could make $1 million move from Tesla into another company, or sell or buy another stock, etc. So liquidity is very easy. It's easy to move in and out of position. In real estate, especially apartment buildings, commercial real estate, you're looking at 90 days minimum to close, right? You have to market the property for 2 months, etc. And it's a 6-month thing just to move the property. You're very illiquid, right? So money cannot be moved in and out. In the end, when you're investing in real estate, you want to invest with a long-term mindset, right? When you're investing in stocks, it's a long-term mindset for most. Hey, I'm going to leave this in here anyway, and I'm just going to watch it. I'm not going to touch it. So it doesn't really matter what happens day to day. Well, that's the same thing with real estate. And if you know that, then you don't have to worry about the liquidity, right? You have to know that when you're going in, that your money is going to be tied up in a 3 to 7 year or longer period. You're going to get all the advantages of cash flows and tax advantages, but your money is going to be tied up while it continues to work for you. So that's one thing you got to consider. But why is that an advantage? Well, the advantage is it saves you from yourself, because a lot of people, the way that they lose money most of the time in stocks is because they don't stay in positions. They buy something, they see some news article or a meme of some kind, and they start moving from one investment to another investment. Or I got to dump this company's about to go under. I got to dump all this stock. I'm going to buy something else. And that trading, that actual ability to have liquidity is what causes people to run into problems, because they're touching it. So illiquidity, I would look at it as, yeah, there's a con that you can't take your money out when you want it, but B, there's a pro that it saves you from yourself. All right, guys, there you have it. I hope you got a lot of information from this. I mean, what do you think? Do you agree with me? Is passive real estate investing way better than stocks? Let me know in the comments below. Maybe you disagree. If you have ideas for future videos, leave them in the comments below. Smash the like button if you love this episode. Share this with a colleague that needs to hear this. We need to grow our community. We need to get our word out there. And a great word, in the words of the late and great Jerry Springer, take care of yourself and each other. Until next time, I'm Dr. Jonny Walker.